If you're still confused about where to buy or where to sell, this video is for you. Market structure is the simplest way to see what the market is doing. And once you master it, entries become obvious, stop losses make sense, and you stop forcing trades. Let me show you how to read the market like a pro. I'm Kojaks Pro. Let's go make your trading better in 3 easy steps. Step 1. The 3 market states. The market is always doing one of 3 things: trending up, trending down, or going sideways. Your job as a trader is to identify which one we are in and align with it. Trying to sell in an uptrend or buy in a downtrend is like swimming upstream. This is why most beginner traders lose, because they are clicking everything. They are clicking buys in a selling market, or clicking sells in a buying market, or clicking the both of them in a sideways or ranging market. When I was coming up as a trader and my screen was filled with a lot of indicators, my charts weren't clear, and that's why I was taking trades here and there. I was clicking a lot of buys and sells buttons. I was always thinking that the indicators are the ones helping me to make profitable trades. And do you know what exactly happened? I actually did make some profits, but most times it stops. The indicator which I so much relied on began to fail. I kept on asking myself, why is it each time I change one indicator strategy to the next indicator strategy, it seems to work for a while and then stop? And that's why I used a lot of indicators, thinking that there is something wrong with my execution and not with the indicator. But the problem relied on the fact that I was doing the wrong thing from the market's perspective. The market does one of these 3 things. It's either it's ranging, it's either it's going up or going down. So what happened is that once you're trading with indicators, because they lag, they are showing you price action in its later form. You don't know that the price has actually changed, and you enter into markets that was previously bullish and has now gone bearish. What happened to my accounts in all my months and years of using indicators? Your guess is as good as mine. I blew all of them. If only I knew that I shouldn't take a sell in a buying market, even if the indicator told me to do so, I should probably have had most of my accounts still running. I should have been able to marry intelligently and, technically, the indicator signal and my ability to read price, just knowing from the charts that price is now going up, and then I should align my trades to the upside. Probably I would have been a bit more profitable earlier on. Learn from my mistake and don't take signals blindly. Step 2, mapping structure. Once you've identified the trend, map out your swing highs and swing lows. These points are what form your roadmap. In an uptrend, you are looking for price to pull back to a higher low and then break above the last high. That is your signal for a continued trend. Now you ask yourself, how do you know how far the pullback will be? That is one question I used to ask myself when I was a beginner. Now I'll tell you this so that you stop fussing over it and become a better trader. The market is going to pull back to either the last swing high, the level at the last swing high, or it's going to pull back to a trend lines level. Once you've had a trend line from one point to the next, those touches on your trend lines, usually on the diagonal axis, they have a zone. The market is likely going to pull back to those zones, or the market is going to pull back to a Fibonacci level. Most times, the market always pulls back to the 50 Fibonacci level. And I'll show you later on in this video when I'm giving examples on charts. Step 3, structure breaks. The most powerful moment is when structure breaks. When a higher low fails and price makes a lower low, the market might be reversing. This is your chance to stop buying and start preparing for shorts. This single concept, structure breaks, can keep you from holding losers too long. Now, let's put this into perspective on the chart. This is an AUD/USD chart. Now, the first thing we'll do is to identify whether this market is going up or going down. Now, it's very clearly seen here that the market is going down, and that can be showed with our trend line right about here. So this is our trend line, which shows that the market is actually trading to the downside. Now, we have identified that we want to know when exactly this market is going to want to change its direction. Now, the only way to know that is by structure. Now, you will see here that the market made a swing low here. This is a swing high, which is lower, the characteristics of a downtrend. Then the next one is another swing low, which was lower than this one. So it's also swung to the upside again, higher than this one, actually lower than this one. That's still the downtrend still continues, and then up to this point. So actually the market swung to this point here and then went up and then came here. And so all this while we have been making the clear-cut characteristics of a downtrend: lower highs, lower lows, lower highs, and lower lows. Now the market got to this point and then created an equal high. So see that an equal high has been created right about here. So an equal high was being created right about here. I'm just going to color it that color. And the market chose not to make a lower low. So guys, take a look at here. This is a higher low. It's higher than this one. So when the market begins to change characteristics like this, you have to be careful and cautious to know what exactly the market wants to do. But if you were on a trade, you continue your trade up until the structure breaks, because as of now, the structure hasn't been broken yet. Now watch what happens next. As you can see, we have clearly broken structure. So structure, this was the last swing, the last lower high, and the market has now broken it with a full erect bullish candle. Now, as at this point, after this break, this is where you should close your trades. If you were trading to the downside, you should start thinking of flipping your bias for the short term if you are a trader that loves to take entries all the time. Now look at what happened next here. You can see that the market continued to go up and it now spun out to be a bullish trend. Now let's look at another chart, still on AUDUSD. Now the same principle still applies. We can see that we were in an uptrend. The market is heading to the upside, making characteristic movements of a bullish market. So these are the characteristic movement of a bullish market with higher highs and higher lows. Now this has happened up until this point. We'll take that off, and then what happens next. Now the market came here right at this point and chose to make a lower high. Now the market has failed to break. The market failed to break this high and instead created a lower high. Now this should also tell you that the trend is about changing, even if it's for the meantime. And if you are holding profits, or you've been holding profits all the way down from here to this upside, you should be thinking of locking in your profits or completely, exiting the trade. But do not do that up until the actual break of structure happens. So now watch that this is actually structure. So follow me, guys. This is actually structure right about here, because this was the last swing low the market made, giving birth to this higher high. So whenever this level breaks, the market has officially broken structure. Now, should we see whether the market does that? Let's just look at. So I'm going to elevate it to this place. You can see that the market actually did that right about here. So once this happens on the daily time frame, a full daily candle close, like you can see, a full daily candle close right here, you should exit your previous upside trades and start looking to sell. Now let's see whether this market continue to the upside or actually change direction. You can see clearly now that the direction of the market actually changed to the downside. Now let's look at Bitcoin. Now in this case, Bitcoin broke structure right about here to continue to the upside. So Bitcoin broke this structure here. This was the last swing low Bitcoin made. It's rallied all the way around this level until it broke it. Once the break was complete, it continued this original trend, because before then Bitcoin has been bullish. So you can see clearly here that Bitcoin has been bullish. So this has showed that Bitcoin has been bullish all this while. Now, when that happened, I told you guys that whenever the market does this, it's going to do one of two things. It's either going to pull back to a structural level, like in this case, it's either going to want to pull back to support to continue its move to the upside, or it's going to pull back to a trend lines level, or it's going to pull back to a Fibonacci level. Now, for this case, the market actually pulled back to a Fibonacci level. Now, let's see the pullback. So for those that don't know what I mean by pullback, this is the market pulling back to base, because the market doesn't just go in a straight line. It has to move to the upside, take its breath, allow some other traders to hop on the trade, those that know where the direction of the market actually is, and then follow the market to the next zone because the market moves from zone to zone. So in this case, it's pulling back to try to pick up passengers. It's pulling back to try to get some more traders on board. It's not reversing. The reversal comes when structure breaks. Now, let's see at what level this market pulled back to. So I'm going to draw my Fibonacci now from swing low actually to swing high. So this is the 50 Fibonacci area. This is the 50 Fibonacci area. You can see 0.5 right about here. And then we'll wait for the market to actually do that. So the market pulled back to this entire level, which is the Fib area. So I'm just going to mark this as the Fibonacci area. Then put it right about here because that's the Fib area. And we'll use our trend line, our counter trend line, to wait for whenever the market breaks this counter trend line. Now let's see whether the market did that. So it pulled back there, held there, and then broke the trade. Broke the counter trend line right about here. Although I love to see full breaks. So in this case, I'll wait for a full break. So that's how to actually enter a market cautiously. Watch that I didn't use this candle. So I'm just going to zoom it a bit. I didn't use this candle, though some will say that the candle is okay to enter. I want the market to break out convincingly. This is okay for a break, but for the mere fact that I am seeing wicks that the break didn't start or didn't go through entirely the body of the candle, I'm not interested in it. I love to see full breaks. So I'm going to wait until this full break happens. So when I saw this candle, this candle now shows me that I am ready to take my trade. So you can see now this candle clearly has begun to go, and that is my cue to get into this trade. So that's how we get into this trade. So continue and move to the upside. So this is how I enter my trades. My stop comes below, like you see in this case, comes below here. And then my take profit comes, my first take profit level comes to the 100% retracement. So in this case, I'm taking my profits right around here, part of it. So I'll take partial profits here and allow the trade to continue to the upside. Now let's see whether this trade went in our favor. You can see clearly that the market did hit our take profit. Next up, let's look at Euro NZD. Now, same thing, we've identified that the trend is going downwards. So all this while, we're busy selling to the downside, waiting for when structure breaks. So where does structure break, guys? So we've identified here as the last swing high. So that's the last swing high. And whenever the market comes to break this level, it means that we have officially broken structure. Now let's see whether the market did that. So you can see that the market has now come and broken above that. So the principle applies. If you were holding trades to the downside and this happens, you should exit your trades and start looking for a trade reversal if you like to take a lot of trades. Now let's see whether after this structural break, the market continued to move to the downside, or whether what I'm actually saying is true. So whenever the market breaks structure, we should expect a change in the market direction. So we can see that the market actually changed its direction. Now, one more chart example to drive this home further. This is GBP CAD. Now we identify the trend. Now we have seen that we are trading to the downside, clearly stated right here. Now we're trading to the downside. Where is the last swing high on this trade? The last swing high is right here. So this is where structure is. So this is where structure is, because if you look at it, you will see that we moved up a bit to the upside, just like so. So this is where structure is. Don't get it twisted. Now we're going to check whether this market is actually going to continue moving to the downside, because what I see here, I see that there is a lot of buying pressure right around here with this very long wick. It just shows that a lot of buyers are aching to get into this market. So we'll just see whether this structure will be taken off. So you can see clearly that the market broke above structure. So the market broke above structure right about here. So if you were holding your trades to the downside and this happens, it's your cue to get off. As a matter of fact, in this type of markets, I don't even wait for structure to get broken. Because of my experience, I know that whenever I see this, you see this right here. Whenever I see this, I'm off, because this is like a mini chart reversal pattern, a mini one. So whenever I see this with a very long doji, I'm off most times, especially when it's happening on the daily time frame. So let's see whether this market was actually reversed. So you can see clearly that the market went back to the upside. Notice I'm not just guessing. I'm letting the market tell me where it's invalidated. Now, I'll tell you the type of mistakes, common mistakes traders make when they don't know about this. 1. Chasing after structural breakouts without waiting for the retest. I've always told you that. Always wait for the retest. Do not follow a breakout. That is the best way to trade. That is the professional way of trading. A break plus a retest. Number 2, trading ranges like trends. The same strategy you apply to an uptrend, the same strategy you apply to a downtrend. So basically the same strategy you're applying to a trending market, you do not use them on a ranging market. If you try to use a trending strategy in a ranging market or a choppy market, the market is going to chop your trades. Forgive my slang, but that's just what it is. If you use the strategy you use or you are used to for a trending market in a ranging market or a consolidation market, that strategy is going to break. So if you were having a lot of wins using that strategy, the moment you try it on a ranging market, it will break. So in order to trade ranging market, you need to use range-based strategies, and there are range-based strategies to use. But if you do not know them, you are going to lose out on all your trades. There's this concept called beginner's luck in trading, where a newbie comes into the game of trading and takes his first few trades just to see what the market does for him. And somehow, fortunately, he's profitable, or unfortunately, he's profitable, and begins to think or buys into the wrong notion that trading is easy. And then before you know it, he begins to stake his real money, hard-earned cash, savings, investments, all that into trading, only for the market to do what it does best, which is to rip you off your funds once you don't know what you're doing. So this is what happens actually. What happens actually is that most times if they get in, they might get in, fortunately, when the market is about kicking off and the market is in an uptrend. Now, they will not realize that the market is about changing the trend because obviously they don't know what an uptrend and downtrend means. They just feel the market is going up and they want to ride the wave, but they don't know when the wave is about to change. So whenever the wave changes, it changes along with the whole profits it's giving them. So this is how it is. Do not trade in a choppy market. When you are using your trading strategies, make sure you're using it in the right market. If you're using a trend-based strategy, continue with it. If you have a range-based strategy, use it for a ranging market. And in case you do not have a range-based strategy or a trending strategy, I've got a free resource for you at the end of this video. Just go to the description and click on the resource. The price sensor quiz that is my whole entire body of work. It's going to help you transform your trading. You see the kind of trading results I get, the kind of analysis I make. I don't trade all the time, but when I trade, I strike gold because I am a swing trader and I wait for the market to actually come to me to be able to trade. Now, if you trade in this way, you are going to become profitable. I'm going to be very, very honest about that because what makes a lot of traders unprofitable is because of what they don't know. If you know what I know, you'll be able to trade this market easily. You'll be able to trade this market with clarity and confidence. And that's where I put my whole body of work into. The price actions quick start. It's going to help you transform your trading from a newbie to professional, and you'll be able to see trades and trading opportunities the same way I do. You don't see this kind of resource anywhere on the internet. That's why I'm very, very open about it. Make sure you go to the description of this video and join the course. Now, the third mistake traders make is to ignore higher time frame bias or higher time frame structure. Now, if you are so zoomed in to trading in the 5-minute chart, the 15-minute chart, you don't know what's happening on the daily. You don't know what's happening on the weekly and the monthly. Most times, when it feels like you are trading better in those small time frames, the market will get to a point where you just don't understand why your trades didn't go as planned. You had already mapped out your risk reward on where your profit target is going to be, and the market doesn't get there and reverses on you. You start asking yourself, what's happening around here? Most likely, the market has gotten to a higher time frame structure, i.e., the daily time frame structure. Maybe it's a daily time frame supply level, maybe it's a daily time frame demand level, or a monthly or weekly time frame level, as the case may be. So if you know how to strategically move through zones and to follow the higher time frame bias, you'll be overall profitable. You'll be better off as a trader with more profitable trades than you are just looking for trade entries here and there. So traders, master this skill and you will never look at the market the same way ever again. Market structure is a core part of price action, and a lot of traders don't know this. I've got a free resource for you, Price Action Secrets. It's going to show you how to actually look at the market, use price action to trade profitably, and get you to a better state of trading with clarity and confidence. Grab it below, it's in the description. And if you're serious about trading, get the price action quick start and become a better trader. Subscribe to the channel because I'll be dropping more professional tips and strategies as regards forex trading and making you a better forex trader. See you in my next video.